call the Retirement Board of Allegheny County meeting to order. Our first item is a Pledge of Allegiance. Please stand if you're able. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Walt, would you please take the roll call?
Yes. Frank DeCristofaro.
Here.
Sarah Innamorato.
Here.
Kimberly Joyce.
Here.
Jennifer Liptak.
Here.
Corey O'Connor.
Amy Wise here on behalf of Corey O'Connor.
Sarah Roca. President Brusslers.
Present. Are there any public comments?
There are none.
President's update. This morning at 10:30, we had a working group on planned funding. And then immediately following the session, there will be an executive board meeting, and those are all my updates.
Thank you.
Oh, I'm sorry, the email dated April 22nd.
Hold on.
That's the email. And I'm in the
Pausing for technicalities.
All right, sorry about that. Under board approvals, the first is a motion to approve the board meeting minutes from the May 15th, 2025 board meeting.
Second.
Having a motion and a second, is there any discussion? Hearing none, all in favor? Aye. Any opposed? The motion passes.
The next is a motion to accept the financial statements, which include the pension fund assets, the statement of changes in plan net assets, and the RBAC balance sheet for April of 2025.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Hearing none, all in favor? Aye.
Aye.
Any opposed? Motion passes.
The next is a motion to approve the following June 2025 applications. The attached applications have been filed with the Retirement Office for pension approval by the board. There are 6 early voluntary and 15 full retirement.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Hearing none, all in favor?
Aye.
Any opposed? Motion passes. Next, we have our director report. We have reports. Our first one, Director Szymanski.
Thank you very much. So if you turn to the Directors tab in your board books, there has been an updated table for presentation. So one thing, retiree payroll's up 4%, but we have broken out now the total contributions made. So I've separated between county and airport to show that there's been an increase in both over last year, total of 4.71%. County is up 4.07%, and the airport's up 10%. Contribution refunds are down 35%. And I have a new section of the dashboard since our new software can track active employees, payees, and deferred vested. It's the first time in probably over 5 years that the active headcount, including the airport, is over 7,000 employees. So I like to commend the administration on hiring. Payees are at 5456, and our deferred vested members currently are at 383. If you turn to the next page, total retirements are up 7%. Pension estimates are up, but once again, it'll be because as of last year, we weren't tracking the online portal logins. We've also made some changes on the dashboard, so I've removed the investment portion since Mariner reports on that now. So I will just be reporting on the cash account that's transferred for payroll, the BlackRock liquidity account until it's wound down, and then any capital calls that we process in between board meetings. And then I also have the office budget there as of May 31st, 2025. Do we have any questions on the dashboard?
It seems we don't.
Okay. So next I'll move to my board approvals. The first will be a motion to approve the RFP for auditing services. Once approved, it'll be sent to the purchasing department to be posted.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Hearing none, all in favor? Aye.
Aye.
Any opposed? The motion passes.
Next will be a motion to approve the 2024 annual report for printing and mailing.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Hearing none, all in favor? Aye. Any opposed? Motion passes.
The next will be a motion to approve the Wolf Popper as a class action litigation firm. This would add them to our panel of class action firms. The draft was included with the May board materials.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Can you recap for us, you and Brian will be, what you'll be doing later this year on our class?
We're going to work on it in July. We're going to
Okay.
come up with class action parameters and a policy, so that way when firms come to us, they'll all have a copy of the policy, such as thresholds on limits of the litigation, who comes to us first, but we'll bring a draft to the board in August, so we're hoping to have that approved by the end of the year.
Great, thank you.
Thank you.
Is there any other discussion? All in favor to approve Wolf Popper? Aye.
Aye.
Any opposed? Motion passes.
The next motion is to approve Bleachmere Fontaine Auld LLP class action proposal. This would add them to our panel of class action firms, and as the one before, the proposal was included with the May board materials.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Hearing none, all in favor? Aye.
Aye.
Any opposed? Motion passes.
Okay, next are some board updates. The retirement board staff, controller's office staff, and treasurer's office staff visited BNY on May 29th, 2025. BNY gave us an update on our current information and met all of our various team members. And then staff are also visiting the Kane centers to review benefits, answer questions, and run calculations. We'll also be going out to the county police and the county airport police in the summer, along with some other departments that we're working on scheduling. So if you have any suggestions or any departments that need to be reached out, please let me know, and we'll work with them.
Thank you. Any other questions or anything for Walt? All right, thanks.
Thank you.
Next we have, boop, boop, boop. Brian Gabriel, our solicitor.
Thank you, Erica. I did want to note for the record that the executive session immediately following will be to discuss pending litigation at docket number AR 24-1721 in the Court of Common Pleas.
Thank you.
The solicitor's report is current as of June 9. I have no other items to bring to the board's attention, but I'd be happy to answer any questions.
Are there any questions? No questions. Thank you.
Thank you.
Next we have our consultants, Chris Brokaw.
Thank you. If you turn to the tab in the book labeled Reports, Mariner, there's a memo, and highlighted at the top, I think, is the most important item there. No action is required at this time. So I did want to bring this to your attention, and it just it's a good time to talk about the private investments in your portfolio. This actual request is from Pharos Capital, one of your private equity managers, and as of July 31st, 2025, their contractual term will expire. Their term was typical. It was 10 years plus the potential for 2 years of extension that they could, automatically receive. So it's been 12 years, and there's still assets in the portfolio, and they are requesting an additional 2-year extension. So we're recommending against providing that 2-year extension because of the focus on liquidity that you have in the portfolio, as well as the potential going forward. We have to consider whether or not illiquid investments, that there'll be additional commitments. So of note is by responding, or by not responding, by not consenting to this extension, it doesn't mean that the investment won't be extended. It's at the vote of all of the partners in the plan, and usually, just based on history, it usually is extended. So it probably, even if you don't vote for it, probably will be extended. You, again, will not necessarily, you won't get the current value of the portfolio at any time before any of the other limited partners. And I spent some time talking about this because it's representative of many investments in your portfolio in the private equity that have been part of the portfolio for 10, 11, 12, 13, 14 years. Again, no action is required. Another update that I think is worth mentioning, that in the quarter to date, there are 10 different distributions from your private equity portfolio. So those managers, those funds in your portfolio, of which there's about approximately 40, they continue to make distributions. The majority, the vast majority of the investments are in that mature phase. So just want to, provide that update as well. So thank you. If you have any questions, I'd be happy to answer.
I have one. Does anyone else have any? I'll go first. Even if everyone voted to not extend, like practically speaking, would that actually speed the windup of these things or no?
Right. I didn't get to that part because it probably will be extended. So if the majority, and there is a growing number of limited partners, that's what you're called as the investors in these funds, that are, colloquially sick and tired of not getting their money back and want to get it back as soon as possible. If the situation were to arise that it was not approved, that's really more of a, okay, now the manager has to revisit the portfolio. It is illiquid, but I would say what it does is really put more pressure on them to shorten that time frame. You could think of these sales as if you wanted to sell your house, for example. There's a price that you may want, and there's a price that the market may accept. So you can always lower the price, push to get your home sold more quickly. And it's the same with these investments. They would shorten that time frame from 2 years to some shorter period, but there's no guarantee because it's in the market.
Thank you. All right, thanks.
Thank you.
Next we have, woohoo, actuaries. We have Brad Rigby from Acrisure with all kinds of stuff on the agenda.
Yeah, we've got a bunch this time, and thank you. Todd sends his regrets. He's on a family vacation this week, but happy to walk through this with you. Our materials are behind the tab that follows, and as was mentioned, there's a bunch that we want to cover. A lot of it is follow-up to what we've talked about in prior meetings, but also diving in a little bit deeper and providing some information, answering questions that have come up, not only here, but in the working group as well, and we were asked to provide them in this meeting. So I'm going to start on page 4 with an update on a couple of key charts that we've shown in recent meetings that reflect updated preliminary financial results through the end of April. And on that page 4, there's a lot going on here, and I'm going to explain a little bit of the detail because it highlights really how contribution requirements are going to change over the course of time as we see them happening right now. So looking at the vertical bars first, those are benefit payments for the couple of years that are historical and known, and then on a projected basis going forward based upon the census that we had at the beginning of 2024. So the blue bars are the people who are already in payment as of the beginning of 2024. Those numbers decrease over time as your retirees pass away and are no longer in payment at a future point in time. And that's based upon the assumption that we have in place using a standardized table of life expectancies. The small little green bar that's added on top of it are those that are currently a deferred vested member in the plan, left employment but are due a benefit when it comes to retirement age and when they collect at some point in the future based upon the assumed retirement age, then similarly it dwindles over time based upon their life expectancy. Then you have a larger group that starts in 2024. Those are the employees who are active as of the beginning of the year, and some are eligible to retire immediately but haven't and are expected to in the near future. Some will become eligible, say 10, 15, 20 years down the road, and then would retire at that point in time. But then during the course of their retirement, collect additional benefits on top of those who are already in payment. And that is what, as Walt reports every meeting, swells the number regularly in the amount that's getting paid out every month in that retiree payroll. So you can see that those gold bars climb even when added to a declining population in the retiree base to the point where it's not more than 6 or 7 years down the road where we think in total the plan's going to be paying out close to $200 million a year in retiree benefits. And then the additive purple on top are the people that we assume are going to be hired to replace the active population when they leave employment, whether that be through retirement or elsewise. You hire new employees into the system to perform the key work that's being done, and then they, later down the road, collect a benefit from whatever means that would be. So as you can see, over time, benefit payments are projected to continue to increase to the point where if we're 40 years down the road in the early 2060s, we're approaching $300 million a year being paid out of the system. Now, right now, we're in the neighborhood of 150 million, still a significant number, but that's projected to climb over time. And there's a big piece of that. As employees continue to work, there are salary adjustments that are assumed to occur, because they do occur, and that grows the size of benefit. That's all baked into here as well. But over the course of the time, the system's going to be paying out a whole lot annually, obviously happening monthly, but we're showing annually here. Significant amounts of money coming out of the system. That's what this thing was built to do, right? It's built to provide retirement benefits, so that's a good thing. But when we marry that in with the funding situation and the fact that having that money available for benefits only comes through contributions and investment income, it puts a strain when we think about the size of those benefit payments relative to the assets right now at around $950 million. So the line charts that are also added on top of here show a couple of different items. The red and green lines are on top of each other for the next, say, 14, 15 years, because those are the employee and county contribution amounts on a projected basis, which is 11% of payroll. Until such time, which right now is projected to be around 2040, when, because of these large distributions of benefits happening regularly, the plan's projected to become insolvent. And at that point in time, the need to pay for benefits, should no other adjustments happen, which we will talk about other adjustments, but then it just becomes additional contributions in order to make those annual payroll items. And in that situation, you also have no investments set aside, because you're really just paying out what's coming in immediately. So the county contribution piece increases drastically in 2040 to almost $200 million a year should nothing happen. And that's really just to make sure that in total, with the 11% employee piece and then that county piece inflated, rises to enough of the benefit payments. And then the reasons why it's slightly above the top bar is because then you also have operational expenses from the administrative side of running the plan. So really, the money just comes in and then goes out right away to pay benefits. But this is why you're taking extensive efforts now to try to solve something in a longer period of time than just waiting until it occurs around 2040. Any questions before we move to the next page? This was a page that we did show at the last meeting, so it's a minor update. On page 5, we're actually showing here the projection of plan assets over the course of the next 15 years or so. I'll point to the blue line first. This is your current situation with no changes in contribution structure, but reflecting the 7% assumed investment return, which we'll talk about in just a bit. So effectively, your current situation. I'll then draw your attention to the purple line, because it's kind of what Walt mentioned, drew attention to in his report. A population increase, we were asked to show what the sensitivity might be, how are our results impacted if we do achieve some population growth, some additional employees into the system that has been discussed for a while. And Walt mentioned for the first time in a while, we're over 7,000 employees, and that helps. That's close to the 10% growth that we built into this projection to occur over 3 years, because we just didn't think it would happen as fast as you did it. But the fact that you're almost there means that we're pretty close to maybe this purple line. What is of note, however, is that really the 10% population increase only adds 1 year to that solvency date. So instead of being 2040, it's 2041. That's not to say that it's not worth doing, right? Obviously, every little bit is helpful, but it's not like all of a sudden the 10% population increase is going to add 10 years. It adds 1. And the other 2 lines are to show the impact of investment returns not meeting that 7% assumption in a catastrophic way. So what if we stress test the funding picture and inject a pretty catastrophic event? The green is if we all of a sudden lose 15%, just the market's not there, the portfolio loses 15% in a single year, what would that do? Not that any of us are hoping for it by any stretch, but hypothetically speaking, we would lose 4 years on solvency for just that 1 year of return. Now, this is probably an overly catastrophic illustration, because even though 15% loss is within the realm of possibility, it's happened in the not too distant past. Usually when those occur, there's a bump back up in a year that follows, and we're not illustrating that hypothetical here. This is just a 15% down and then back to our 7% annual income. So this is probably worse than what would truly occur in that down 15% market year. And then the gold line is the 15% down, but we combine it in with the population increase. And similarly there, that 10% population increase adds 1 year to that down market situation. So obviously it's important to have, some of this is to illustrate, it's important to have less than overly volatile assets. Down 15% is going to be detrimental to any pension plan, but it's particularly so here in our situation.
Right, yeah. Just wow. I mean, so just trying to get my head around what Acrisure is seeing based on the data is that our benefit payouts are going to double,
Over the course of 25 to 30 years, yeah.
That's really, that's really over 20 years, from 2021 to 2040. Oh, no, I guess, yeah, all the way out to 2060.
2062 is the end of this illustrated period here where we're talking about
35
benefits
years.
doubling. Yeah.
That's just such a dramatic increase. Just wondering if it's the number of employees retiring or the rate of their salary, pensionable wages driving that number. That's just such a big number. But just want to confirm that what you just said, Brad, is that a 15% loss in 1 year, we lose 4 years of solvency.
Correct. And that's in a situation where there's not a rebound in a year following the 15%. You just go back to the 7%.
You just go back to 7.
Mm-hmm.
So that's significant, but yet a 10% growth, which as of 1/1/24, we had 6,500 employees. So with 650 more, well, we had 500 more employees, but with 10% growth, which would have been 650 new employees paying in, that only bought us 1 year. So we can't hire our way out of this situation.
It would take more than 10%, I'll put it that way.
Thanks.
The thing I didn't realize that I see on this graph is that
is what a small percent of the obligation the current actives are. Like it's less than a sixth, a seventh?
Where's
am I
that?
looking- Like on the bar chart on 2025, right, like the brown part.
That's not liability,
Oh, that's
actual
benefit payments.
distributions.
Never mind. Now it does, I take back everything I said. It makes sense. Okay. Back. Are there any other questions? Thank you.
All right.
Keep going.
I'm going to step into the next, page 7. We've talked about this for over a year now, but I think we want to formally bring to you a recommendation to lower the target return assumption that we've been reflecting within the liability growth and the projections, but also is used at Mariner to help you build a portfolio reflecting your risk strategy. We're recommending a lowering of that assumption from 7.75% to 7%. Detailed on page 7, I have several bullet points on why, if there's discussion, we feel that that's appropriate. I mean, I'll start really with the bottom. In that 7.75 sticks out among your peers as a pretty large bogey to hit. Most plans are in the 6.5 to 7 range now, looking at longer term obligations. But really, it's to focus on conversations that we've had over the last 12 months or so, talking about your risk strategy and your tolerance for taking on risk. But as Chris also mentioned while he was speaking, the changing need for liquidity over the course of time and the pulling back of some of those longer term, higher returning over a 10, 15-year investment horizon, those types of instruments lowers the fund's ability to achieve that 7.75, especially when we're highly cash flow negative, meaning paying out a good amount more in benefit payments every year than are coming in contributions. So that makes achieving 7.75, and not only achieving it like say 50% of the time, but then achieving it enough to above and beyond beat and keep hold with the down years of lesser return. 7% is a much better assumption. And arguably, I think that as we move forward over the next couple of years and have similar discussions around the percentage of assets that are getting distributed every year in benefit payments, it might be warranted to revise this and look at this on a regular basis, not annually, I'm not suggesting that, but maybe every 5-6 years, because it might be warranted to change it more.
Can I ask a question?
Should we do a motion and then discussion, or do you want to ask a question
yeah,
first?
I'm
Either one's
sorry.
fine with me.
Oh, okay, no, that's fine.
Can I have a motion to lower the investment return assumption rate to 7%?
Make that motion.
Second.
I hear a motion in a second. Is there any discussion? Member Liptak?
Yeah, I just have a question. So what you're saying is...
Is your mic on?
If I just want to clarify, with the acceleration of our need to draw from our investments to fulfill our benefit payouts, it's accelerated the need to further drop that rate. And as you're saying, we have to draw more dollars from our investments. It may accelerate that even more. So we may be looking in the future having to drop that assumption because we're not able to maintain enough in our investments to hold a higher rate.
Yeah.
So if we plug that and figure out a way to stop drawing as much money out to allow for us to have a rate that would probably be more consistent with what we see out other places. I think you said 6.5 to 7 is about average now, and 7 is the number like that we've heard. It was 8, and we dropped it, and now it's 7. But what you're saying is because of the way we're drawing from our investments, we may have to go lower in the future.
Yeah, and I'm going to maybe...
Let me clarify that so we're
Yeah.
clear.
And that is important to note. As you find solutions that hold asset levels higher, you will absolutely have the greater ability to hold assets that can be either in longer length investments, but you won't be drawing down as much relative to your benefit payments. That does allow you the opportunity to keep that return target a little bit higher. Ultimately, and just to add some more color, ultimately, when you're selling off so much of your portfolio annually to make distributions, you're probably liquidating assets at a time that's less than ideal. That it may be that some of them are ideal, but not necessarily going to be the case in all times, and so that's going to hinder your ability. And plus, you're not able to hold things in longer-term illiquid investments that can generally provide higher returns. So it does put a strain on a lot of that.
Thank you, I appreciate the clarification. I think that helps provide perspective that this may have to happen again, and it may have to go below what the norm is at some point if we continue down this path, meaning below that 7.5, which seems to be like a norm for everyone else, and we have to go based upon our draw. That, I just wanted clarity.
Yep, yep. Another point I might add, if I can, is that looking at insolvency on the horizon, as we just talked through in the prior chart, means that there's, especially in that situation we were stress testing negative investment returns, shows that there's such a need for preservation of assets. The downside of negative returns is significantly consequential, so you're probably going to move into a much less volatile asset class, which naturally brings down return expectations as well.
Was there anything you wanted to add, Chris, on this, or is this good?
No, I think
Okay. Excellent.
he said it all.
Are there any other questions?
Oh, I'm sorry. Okay. No, Corey wasn't able to be here today, and he just wanted to share that he is supportive of reducing the rate of return to 7%. It's, more in line with reality, and it will provide a more fiscally responsible view of the health of the fund to bring us more in line, too, with the average rate of return adopted by pension plans across the country, and will help us to get a better idea of our funding needs and to put in perspective the tasks that lie ahead to getting our fund in a more stable situation.
They're here, thank you. And did you have did you want to speak, Executive?
Yes, thank you. So just thinking about how we compare to other jurisdictions, other counties our size, where do we land as far as performance and kind of proceeding with the 7% projections? Are we on par? Are we kind of doing what other counties our size are doing, or other jurisdictions, or are we kind of behind or in front of? Just kind of, if you could put us in that ecosystem.
Yeah, certainly. And I think part of that question maybe falls to your camp, so I'll pass over. But
Okay.
I mean, across the Commonwealth, there's really only 2 other counties that
Yes.
are of your size, right? But they're not in our situation necessarily. So I'm not familiar off the top of my head with what rates they're using as an assumed return, but I can look into that and get you an answer. My expectation fully is that they're very close to that 7%, if not at it. But I can get you a firmer answer. Regarding performance and how that compares, I think it falls in your camp, but I think I might also know the answer. No.
Okay.
You're better.
Yeah, so in terms of performance, especially in recent periods, a lot of performance has been related to asset allocation. So the decision that is really a, decades-long or multi-decades-long decision to invest significant portions of the asset in private equity has, for the last several years, been a drag on portfolio performance. And what I mean by that is the U.S. equity markets, if you look at the S&P 500 broad large cap U.S. equity, is up or was up over 25% in 2023 and 2024. And private equity, not just your portfolio, but private equity, the asset class in general, has not produced those types of returns. And for that reason, other counties, other portfolios have, in the last 2 years, had better performance than your portfolio, and that's directly a result of the asset allocation and of those 25% returns in the public market. And you can see historically in your portfolio, not just the last 2 years, but the last several decades, that it has greater stability. So if there was a market correction in the order of 15%, relative to other plans would lose more money because they have more money in the U.S. stock market. Again, the last 2 years, the stock market, U.S. stock market has gone up considerably and well over the 7 or 7.75 expected return, but above 25%. So hopefully that addresses your question.
Yeah, thank you.
And I'll add one more piece. We do receive a survey results from Marquette, which is another asset investment firm that does a survey of counties. So they're mostly smaller than us. But of around the 40 or 50 counties they survey, we do have the highest current expected return on assets. So this will bring us closer in line. Yeah. Is there any other discussion? We're going to vote. All in favor of lowering the investment return to 7%? Aye.
Aye.
Any opposed? Motion passes. And next we have a quarterly update.
All right, yeah. I'm going to try to go through next couple of pages pretty quick. Page 8 is a similar projection we've shown you in other situations. Your current scenario here now at the 7% return has us on a path. Should no changes be made, but we obviously know that they will as they're evaluated. Insolvency is projected to occur in 2040. The contribution rate that would be necessary, equal per party, to stay solvent indefinitely at that 7% annual return is 17% per party. So that, again, is not a recommendation to move to that. That's just an illustration. And as we look at other things. One of the key items as actuaries consider assumption changes is not looking at the impact on results necessarily to drive the assumption, but instead to drive the assumption with reasonableness and objectives in place. But I do want you to see what the impact of a 7% return does on a couple of key items. So if the 7% return assumption were in place at 2024, on page 9, we tend to focus on the total funded status ratio because it's built into plan design. We were at 64.3 at the beginning of 2024. We would have been at 60.1. So the reason why the funded percentage has come down is because when that interest rate assumption is lowered, liabilities go up. And then in this calculation, liabilities in that denominator, so that the funded percentage ends up coming down. Again, not that you want to, I'm trying to drive lower funded percentages, we're trying to drive a projection to help you understand setting aside money that achieves the stated goals of the plan, which is paying retirees benefits. Similarly, on the next page, for the end of 2024 GASB reporting, we showed the plan at 7.75 with a funded percentage of 30.89. That is calculated using a blended rate because GASB rules after the point of insolvency require us to measure liabilities at a municipal bond index rate. So that single equivalent rate there at 4.98% is really how we calculated liabilities to get to that 30.89%. If we used a 7% assumption, we still would use that municipal bond rate following that point of insolvency, but we use 7% to discount liabilities beforehand. We would only go down to 30.1%, as you can see. So it's less impactful on the GASB side because of their blended liability calculation rules. But again, that's what I wanted to touch on after the decision was made because I just want you to see the impact. Any questions before we move on to the next topic? All right, I'm going to talk about a couple of things. Page 12 is just a history of returns versus the target. You can see things bounce around. Volatility is natural and occurs in every single portfolio regardless of allocation, but you can see ours there historically. 2024 numbers will input once we complete the 2025 valuation, but I can tell you from a report that Mariner gave earlier in the year, preliminary numbers for 2024 actual were 5.86%. So, page 13 shows a comparison of assets and liabilities charted against the axis on the left, the funded percentage charted against the right. I'll just note that you can see that line graph, which is the funded percentage, has been declining for some time as benefit payments going out surpass the contributions coming in. But the last time that we were over 100% funded was 2001. And it's been declining over that time. Various changes have occurred. Obviously, there's been down markets, up markets. But when we're cash flow negative, the down markets are much more impactful than the up markets. Page 14 shows you a comparison over the last 20 years of cash flows going out, that's benefits and expenses in the blue bar, to incoming contributions on the gold bar. And in all situations, you can see that the contribution numbers materially less than the outflow of benefits. Page 15 shows you using actual versus expected return over the last 20 years, how actual return on the growth of a dollar compares to the assumed return on the growth of a dollar. And the reason why this also reflects a little bit of the negative cash flow situation, because that impacts actual returns. Your ability to achieve return is impacted by how you're pulling money out of the plan. And so over the course of the 20 years, a single dollar that would earn that 8% up through 2010, and then the 7 3/4 after, would be about 4 1/4 right now. Whereas actual returns would have grown that dollar invested 20 years ago to $3. So, cash flows going out impact the returns, makes it difficult to achieve that 7 3/4, and it sets us behind the bar a little bit. We would need exceptional returns for several years to get those lines back together and get caught up with where we were 20 years ago. And then one of the items on page 16 as information, this came out of a meeting that the treasurer and I had maybe 12 months ago or more. But we were asked to look at the impact of some cost of living adjustments that were put into place over the last few decades. If you recall, there's a provision in the plan that, in the county code, that if the total funded status ratio is over 110%, then there's an automatic COLA, non-discretionary, which is why we have a tendency to focus on that ratio when we're talking about the funded position of the plan. The COLAs that went into place from 97 to 02 fell under that situation where the plan was over 110% funded. Therefore, really they were non-discretionary, and while they did have an impact on liabilities of the plan, they were just not something that the board did on its own accord, but had no choice but to do by statute. But since then, there have been 4 cost of living adjustments in 07, in 09, 15, and 20. And we show you here in this table the amount of each COLA, how many were affected, how many retirees were affected, and then the increase in that liability, also the increase in annual benefit payments. And I think, at least during our meeting, the treasurer was a little bit surprised that these weren't much more meaningful, because in the whole scheme of things, when you're talking about a pension fund that's $1.5 billion or more in liabilities, adding extra liability that amounts to about $21 million isn't overly substantial, but then we pull out extra assets annually because of that. And so really the increase in unfunded accrued liability, that's what that UAL stands for, how liabilities compare to assets. Over the course of the period of time here, it's about $70 million. So not a small number, but not a gargantuan number either.
Is a fair way to put it, or an approximate fair way to put it, if we hadn't done those 4 COLAs, we'd have $70 million more dollars in the pension plan right now?
The liabilities and assets would be closer by $70 million.
Yeah.
Yes. Mm-hmm.
Thank you.
Mm-hmm. All right, I'm going to jump to the next topic, if that's all right. We were asked coming out of the...
Can I ask a question?
Yeah.
So can you explain that again? Is that on your valuation as an actuary or the actual numbers? Because you project future valuation. What that $70 million, what does that represent? Actual dollars or your projected dollars?
That is actual. So the liabilities went up by about $50 million. and the assets that got pulled out, or do I have, no, I'm sorry, I have that differently. The liabilities went up by 20 million, and additional assets that have been pulled out have been 50 million
Okay.
for those distributions.
Thank you.
The working group requested that we show some projections on hypothetical situations under consideration about adding additional county contributions annually above and beyond the 11% of payroll that they're contributing now. And so the illustrations that follow reflect, I think we were asked to show 5, 10, and 15, but in our analysis, those numbers weren't as impactful as I think everyone was hoping. And so we showed the impact of 15, 30, and 55 million additionally. Now, 55 was not chosen at random. I'll explain why it is. But looking at the table or the chart on page 19, the blue line is where we are currently, just 11%, no extra. That green line is what our picture looks like if an additional 15 million goes in annually on the county side above and beyond the 11%. And it adds, as you can see there, an additional 3 years to our solvency projection. So instead of being 2040, we're now 2043. And that's because benefit payments are going to continue to climb. So if you think about it this way, 15 million a year over the course of the next, say, 15 years, 20 years, you're looking at $300 million. And that's, yes, it's going to grow with investment income, but when you're paying out 150, 180 million a year, it's not overly substantial in that length of time getting added to the projection period. At 30 million of annual contributions, we're projected to now remain solvent through 2048. So that adds 8 years for a similar reason. And then the 55 million was shown because it's almost that number that is needed annually to stay solvent indefinitely at a 7% return.
I don't know if it's here on a following page. Approximately when in that $55 million scenario would we become 100% funded?
I don't have that here. I can get you an answer, though.
So this assumes the $55 million would start in 26 or
26, yeah. We just had it starting in 26.
So if that were the case, you're saying that, and does that dollar amount equate to the amount that we're drawing out of our investments, basically? Is that what the number is? Is it similar? I'm just assuming. So when I look at how much we're bringing in from employer, that's an amount, and then you have to look investment returns, et cetera, interest, and that gives you how much assets we have. And then what's the amount we pay out to the retirees, plus people who leave the system, et cetera. So there's obviously a pretty big gap between what we're bringing in and what we're putting out. So this number is larger than that number?
It is.
And why
It
is
is
that?
larger because the benefit payments are expected to grow over time. So if we were to pull out the exact number, and what you've proposed is certainly a reasonable way to think about holding a level amount of assets in the portfolio at all times, right? Just making sure the money going out matches the money coming in. This, however, looks at it from a different side, which is holding the money coming into the plan at a level amount every time. And therefore, as more employees retire and benefit payments getting distributed every month and annually grow, then more money is going to get pulled out of the fund. And so it's not going to hold constant an asset value. The asset value will probably decrease a little bit over time, but then climb back up and match liabilities at some point, which is what the treasurer just asked. But this calculation was solving for what number comes in flat annually that makes your assets never hit zero, instead of solving for the here's what's going out, here's what's coming in every year, and what do we need to plug that hole. Does that make sense?
That's another way, though, to look at it, as you said, because if you're going to fill the gap for to allow for the investments to grow, right? The hope is the investments to go, it's like a pay-as-you-go plan, basically. Here's the gap each year, which may be higher or lower depending. This almost looks like a smooth number
It
over a
is.
period of time. So you're taking it, you're smoothing it out and saying, if you pay this over, that should be able to cover the ups and downs in the market, right?
Yes.
Okay.
Yeah.
Sorry, that's.
No, that's
need to
great.
explain.
Actually, I think the next page might illustrate this fairly well, which is going back to the chart before where we were showing contribution amounts, and then when insolvency hits, the big bump up to make sure that we have the money for distributions. That blue line is what was pulled from the prior chart and isolated here. So up through 2040, you just keep paying the 11%, but then it jumps up significantly to meet the benefit payment distribution need. All of that money then jumps out. You're paying almost $200 million in county contributions at that point in time. But prior to that, 11% of payroll. And then each of these 15 million, 30 million, 55 million are that smoothing that you referred to. So that green line is the 15 million. If you smooth in that 15 million over the course of the next 15 years, roughly up through 2041, then it's the bigger bump up, because at that point in time, we've become insolvent and you've got to contribute an amount, but you're smoothing it in 15 million for that period of time. Similarly, the gold bar, you smooth it in at 30 million for a little bit longer period of time, up through 2048, and then we jump up to the contribution need, which is remaining solvent. But at 55 million, it's smoothed, I mean, obviously starting in a large chunk right away, but the same large chunk that over the course of time means that we don't have to bump up and meet that full cash flow need, because you're putting in that 55 million plus 11% of payroll. And so eventually that's a much less contribution threshold once we know that we're going to stay solvent indefinitely.
And you said you picked 55 million for a reason. Is it fair to assume that at 50 million, this would have still
Yep.
cratered at some
Yeah.
date out there? Okay.
Yeah. And it might have been 60 years in the future,
Sure.
but yeah.
Can I ask a dumb question?
No dumb questions.
So in these models, it says that 17% would be the percentage to make us solvent on a permanent basis. If we were 100% funded right now, what would that percentage be?
Per party, I think it is roughly in the neighborhood of 5%.
Okay.
We have that in a separate report that we deliver annually. I don't have the exact one in front of me, but yes.
Okay.
It's in that neighborhood.
Thank you.
I mean, actually, Kimberly, I can probably point to some information on page 21 that highlights this pretty well. Because one of the other things that we were asked to provide is information around what if Allegheny County had funding rules that were similar to other municipalities, not second-class county code, but what you see around the city of Pittsburgh and others, for example, where there's this minimum municipal obligation calculation, where generally speaking, the contribution requirement's built on three parts. Normal cost, which is the actuarial term for the increase in liability for the service that's earned in that coming year. So as employees work another year, they add to the liability for that work, and that's what we call normal cost. That, at a 7% return for 2025, is at roughly $44.5 million, okay? And then administrative expenses, just cost of running the plans, about 1.7 million. If we were fully funded, you would not have this amortization payment number, because you have fully funded all liabilities. There's nothing to spread over the course of time. But here in our funded position, I'll say most MMO calculations use a 10-year amortization, which effectively is a mechanism to get the plan to a full funded position in 10 years. Under our situation, the additional contribution for funding the plan in 10 years is $192 million. So if we're fully funded, to answer your question, we would only have the 44.5 plus the 1.7, call it $46 million. And as a percentage of payroll, that's roughly 10%, split by party, call it 5%. But as you can see here, if we had MMO rules and hadn't been contributing the MMO in this way, right, we'd be in a different situation. But our calculation would be $193 million this year, and that's significant.
And that we don't have an MMO calculation is, I'd say, a major reason why we're lower funded compared to most county pension plans in the state, assuming they're making their MMO, which I've just learned some don't.
Yep. And there's, and on a lot of the smaller municipality side, townships and boroughs and cities, there's state aid that comes in a different way that helps to reduce certain things and adjust. But certainly different rules. The flexibility of not having an MMO calculation has been nice at times because you have more of a direct say in how you're going to fund this on a longer term objective without necessarily being forced into a short-term funding mechanism. But yeah, here we are. That concludes everything that we've prepared for you. If you want me to keep talking, I'm happy to. If you have any other questions, by all means, I'm happy to answer them.
Just the right amount of sobering news for us today. I don't think we want any more. Thank you. I find those examples very helpful and illuminating. Are there any other questions? I'll take that as a no. Oh, is this all of your items? This is all of your
That's all.
items. Excellent. Thank you.
My pleasure. Thank you.
Is there any new business? Seeing no new business, our next meeting will be August 21st, 2025. Immediately following this meeting, we'll have an executive session behind that little door. And can I have a motion to adjourn?
Second.
Okay.